Good afternoon, everybody. Today, the theme of our discussion will be concentrated on ratio analysis, the last part of the financial statement analysis. But before going to ratio analysis, let me complete the balance portion of the cash flow statement. A small fragment of the cash flow statement was left in the yesterday's session due to paucity of time. So let me complete that, then I will go to the ratio analysis. In the cash flow statement, yesterday we had a detailed discussion about the technique of preparation of cash flow statement. Before preparation of the cash flow statement, we had a detailed discussion about the preparation of funds flow statement. There are 4 steps involved in it. The first one is the statement of changes in working capital. Second one is the preparation of individual accounts involving hidden transaction. The third one was the preparation of adjusted profit and loss account or the memorandum of profit and loss account to determine the funds from operation or funds lost in operation. Then the last part was preparation of the funds flow statement. And after preparation of the funds flow statement, it can be converted into cash flow statement by applying the equation. The funds from operation as determined in the memorandum of profit and loss account is to be converted into cash from operation. And for that, a simple equation has to be used. Cash from operation is equal to the funds from operation plus increase in current assets plus increase in current liability minus increase in current asset and minus decrease in current liability. With this equation, we can convert the funds from operation to cash from operation, and with that we can prepare the cash flow statement. While preparing the cash flow statement, we are taking the opening cash and bank balance. Then the inflows of cash were added to the opening balance, and all the outflows of cash was deducted from them. The resultant would be the closing balance, and the closing balance must tally with the balance sheet figure. The closing cash and bank balance must tally with the balance sheet figure as given in the balance sheet as the illustration. And that cash flow statement, that was the technique involved in preparation of the cash flow statement. Besides that, there is an accounting standard 3 which speaks about the format or the way the presentation of the cash flow statement has to be made. As per accounting standard 3, the all inflows and outflows of cash are segregated into 3 components. The first one is the operating flow of cash. It may be inflow from operating sources or it may be outflow from operating sources. The second one is the investing flow of cash. It may also include the inflows and outflows. And the third one was the financing flow of cash. Financing flow of cash also, it may involve the inflows and outflows. Operating flow of cash mainly comes from the operating activities. That means the funds, the cash from operation speaks about the operating flow of cash. There may be inflows and outflows. The net resultant would be the cash from operation. If it is prepared, the operating flow of cash may be prepared in a direct manner or indirect manner. Both are permitted under the accounting standard 3. The presentation speaks like this. And as regards the investment flow of cash, it may be about the buying of fixed assets, sale of fixed assets, and investment in shares and debentures of other companies, and liquidating or the disposing of the shares and debentures of other companies, getting up dividend. All these things will come under the investment activities, the investment flow of cash. And as regards financing flow of cash, it would be the issue of share capital of the company, issue of debentures of the company, taking of loan, either short-term loan or term loans from the banks and the financial institutions, and repayment of the loans also come under the outflow of cash. And if there is any, what is that, dividend paid to the equity shareholders or the preferred shareholders, that will also come under the financing activity of the organization. So when you talk about the accounting standard 3, the cash flow has to be presented in the desired format as given or as prescribed by the accounting standard. SEBI also prescribes certain formats for presentation of the cash flow statement in the annual report of the companies, of the listed companies. There is slight deviation or variation from that of the format given by the accounting standard 3 and the SEBI, but more or less the presentation is similar. But the main thing in both the cases, the most important thing has to be observed is the flows of cash have to be segregated into three segments. One is operating flow of cash. Operating flow means inflows and outflows. Investing flow of cash, inflows and outflows. Then financing flow of cash, inflows and outflows. Opening balance has to be taken as the first item, opening cash and bank balance. Then from all the three segments, inflows have to be added, outflows have to be outflows have to be deducted from the inflows, and the net figure, if positive, it has to be added with the opening balance. If negative, it has to be deducted from the opening balance. Then similarly, the investing flow of cash, the inflows have to be taken separately. The items of outflows from investing activities have to be taken separately, and the difference have to be taken into the outer column. If it is negative, it has to be added with the. If it is negative, it has to be deducted from the opening balance. If it is positive, it has to be added with the opening cash and bank balance. The same principle is also applicable in case of financing flow of cash. The inflows of financing flow are to be taken separately. The outflows from financing flow of cash are to be taken separately. The difference between the two, if it is positive, it has to be added with the opening balance. If it is negative, it has to be deducted from the closing balance. And the resultant would be the closing balance as on the close of the year. And we must ensure that the closing balance is tallying with the balance sheet figure. The opening balance must tally with the balance sheet figure, and the closing balance must tally with the balance sheet figure. So this is about the left out part of the cash flow statement, which could not be discussed yesterday due to shortage or paucity of time. So now let us come to the end part of the ratio analysis. Is the end part of the financial statement analysis, which is coming under ratio analysis. That we will discuss today. That is the theme of our discussion. Ratio, as it is the indicated quotient of two mathematical expressions. That means when two figures are compared with each other for determination of certain result, it is called a ratio. It may be in form of a quantitative figure, or it may be in form of a financial figure. Ratio analysis have been segregated in two ways. It has been segregated or classified. The first one is the traditional classification. Traditional classification of ratios are of three types. One is the income statement ratio. Second one is the balance sheet ratios, and third one is the combined ratios. When both the figures are picked up from the income statement, either from the trading account and profit and loss account, and some ratio is determined, it is called income statement ratio. If both the figures are taken out from the financial statement or from the balance sheet, and some result is determined, it is called the balance sheet ratios. And when one figure is taken from the income statement and the other one is taken from the balance sheet, and some result is determined, it is called the combined ratio. But that was the traditional way of classification of different methods of ratios. But the modern classification of ratio analysis is of four types. One is the liquidity ratio, which speaks about the short-term solvency of the firm, short-term solvency of the organization. The second category of ratio speaks about the activity ratios, which is otherwise called the turnover ratios. And the third category speaks about the leverage ratio, which is about the long-term solvency of the organization. Fourth and the last category of the ratio analysis speaks about the profitability ratios. Profitability ratio, which speaks about the operating efficiency of the organization. So now let us discuss the first category of ratio, about the liquidity ratios. By liquidity of company, it means the company's ability to pay current obligations and indicates the short-term financial viability of the organization. This is what the liquidity means. So the ratios coming under this liquidity category provide a unique measure of liquidity of the firm by establishing a relationship between its current assets and current liabilities. These ratios are also called the balance sheet ratios because the information required for the calculation of liquidity ratios is available in the balance sheet only. The most common liquidity ratios are, the first one is the current ratio. Current ratio, the equation for current ratio is total current assets divided by total current liabilities. When the entire current assets means there are three characteristics of current assets. Current assets are those short-term assets which are to be converted into cash or cash equivalent, which are to be consumed or which has to be used in the process of production within one accounting cycle or one financial year. It is called current assets. So what are the items to be covered under current assets? It may be inventory. Inventory means it may be stock of finished goods, stock of raw material, stock of work in process. It may be sundry debtors. It may be bills receivable. It may be cash and bank balance. It may be short-term advances given to the parties. All these things will be coming under current assets. When current asset is divided by current liability, it will be the current ratio. Current liability means current liabilities are those short-term liabilities which are to be paid or liquidated within one financial year. They are the short-term liabilities. What are the examples of current liabilities? It may be sundry creditors, it may be bills payable, it may be short-term loans, it may be bank overdraft, it may be provisions, it may be outstanding expenses, etc. So total of current assets divided by current liabilities is the current ratio. The total current assets includes those assets which are in form of cash, near cash and convertible into cash within a period of 1 year. It includes cash and bank inventories, bills receivable, marketable securities, prepaid expenses and short-term investments. The current liabilities include all types of liabilities which will mature within a period of 1 year, that is bank overdraft, bills payable, trade creditors, outstanding expenses, provision for tax, proposed dividend, unclaimed dividend, accrued interest, etc. So this is the equation for calculation of current ratio. The current ratio is compared with standard ratio. Generally, a current ratio of 2:1 is considered to be ideal or satisfactory, though it is not applicable in all cases. It depends upon the types and the characteristics of the organization. So the second ratio on coming under this liquidity category is quick ratio, which is otherwise called the acid test ratio. In quick ratio, the quick assets are divided by total current liabilities or quick liabilities. The difference between quick asset and quick liability, or the quick asset and current asset, is there are two items are to be deducted from the current assets in order to convert it into quick assets, that is the inventory stock or prepaid expenses. Other items will remain same for determination of quick asset. Similarly, quick liability is equal to current liability minus bank overdraft and short-term loans. These two items are to be deducted from the current liabilities to find out the quick liability. So when quick asset is divided by quick liability, that is called the acid test ratio, which is otherwise called the quick ratio. It is otherwise called the liquid ratio also. A current asset is considered to be liquid if it is convertible into cash without loss of time and value. Hence, inventory is single out of current assets to find liquid assets. So also the case of prepaid expenses. Generally, a quick ratio of 1:1 is considered to be satisfactory because this means that quick assets of the firm are just equal to the current liabilities, and there doesn't seem to be a possibility of default in payment of the firm. So when the projected daily cash requirement is considered, the cost of goods sold plus general expenses minus depreciation, it is divided by 365. This would be the projected daily cash requirement. It measures the capacity of the firm to meet its immediate cash requirement without resorting to the sales or other sources, that is the time lag of which the firm can operate without resorting to sales receipt. So this is about the liquidity category of ratios. Then come to the activity ratios. The second category of ratios speaks about the activity ratios. The activity ratios, also called the turnover ratios or performance ratios. It is a measure of the movement and thus indicate as to how frequently an account has moved or turned over during a particular period. It shows as to how efficiently and effectively the asset of the firm are being utilized. That's why it is called activity ratio, otherwise called the turnover ratio. The important activity ratios are, the first one is inventory turnover ratio. Inventory turnover ratio is otherwise called the stock turnover ratio. Inventory turnover ratio is equal to cost of goods sold divided by average inventory, where the average inventory would be calculated by opening stock or the opening inventory plus closing inventory. The whole divided by 2 would be the average inventory, and the cost of goods sold would be the opening stock plus purchases plus direct expenses minus closing stock. Here the cost of goods sold is equal to opening stock minus purchase. If there is indirect expenses, that is also to be deducted, and closing stock has to be deducted. So otherwise the cost of goods sold is can be calculated by net sales minus gross profit. When the gross profit is deducted from the net sale, that will also be the cost of goods sold of the organization for a particular period. There is no ideal standard for evaluating the inventory turnover ratio. It should be compared with the inventory turnover ratio of other firms for past inventory ratios of the same firm also. Since this ratio is a test of efficient inventory management, the higher the inventory turnover ratio, the better it is. The concept of inventory turnover ratio can be extended to find out the number of days of the inventory holding. So that is called daily inventory holding, or DIH. Daily inventory holding, that means what should be the ideal inventory holding per day. That can be calculated by dividing 360 divided by the inventory turnover ratio. If in a farm the inventory consists of raw materials, work in progress and finished goods, the activity ratios may be calculated for each of the individual components as follows. We are very much aware that the inventory is the combination of inventory of raw materials, inventory of work in process, and the inventory of finished goods or finished products. So the inventory turnover ratio is to be segregated into raw material turnover ratio, into work in progress turnover ratio, and the finished goods turnover ratio. So the computation of raw material turnover ratio is equal to annual consumption of raw materials divided by average stock of raw materials. Annual consumption of raw material means how much of raw material has been used for production during the particular year. That is the annual consumption over there. That means if there is opening stock of raw materials, it has to be added with purchase of raw materials. Then the closing stock of raw materials is to be deducted therefrom. That would be the annual consumption of raw materials. When that annual consumption of raw materials is deducted from the is divided by the average stock of raw materials, average stock of raw materials has to be computed in the same way. Opening stock of raw materials plus closing stock of raw materials divided by 2. That would be the average stock of raw materials. That would be the raw material turnover ratio. Working process turnover ratio is also to be calculated by annual cost of production. Annual cost of production, it can be found out when the manufacturing account is prepared. The resultant of the manufacturing account is the cost of production. In the left hand side of the manufacturing account, your opening stock of raw material is taken, purchase of raw material is taken, other manufacturing expenses are taken, and in the right hand side the closing stock of raw material is taken. The balancing figure is the cost of production. So that cost of production per year has to be divided by the average work in progress. Work in process means the opening work in process plus closing work in process divided by 2. That would be the work in process turnover ratio. Then finished goods turnover ratio. The finished goods turnover ratio has to be computed in the annual cost of production divided by average finished goods. Average finished goods means the opening stock of finished goods plus closing stock of finished goods divided by divided by 2, that will be the average finished goods. So when the annual cost of production is divided by the average finished goods, the resultant would be the finished goods turnover ratio. Then receivable or debtors turnover ratio. Receivable means the debtors or short-term receivables. Both are commonly called the receivable ratio or debtors ratio. Debtors turnover ratio. For computation of debtors turnover ratio or receivable turnover ratio, the annual net credit sale, it has got a directly this sundry debtor means what? When there is credit sale, it gives rise to sundry debtors. When there is no credit sale, there won't be any sundry debtors. So it has a direct bearing. The sundry debtor or receivables has got a direct bearing with the net credit sales. So annual net credit sales divided by average receivables or average debtors. Opening debtors plus closing debtors divided by 2, that is the average debtors. When the annual net credit sale is divided by the average receivables, that would be the receivable turnover ratio. After calculation of the receivable turnover ratio, then we may be asked for computation of the average collection period. Average collection period, the 360 divided by the receivable turnover ratio or debtors turnover ratio, that would be the average collection period. That is dependent on the credit policy of the organization. That helps in determination of the credit policy of the organization. So that is receivable turnover ratio or debtors turnover ratio. Then payable turnover ratio or creditors turnover ratio. Payable turnover ratio, annual credit sales, annual credit purchase. The debtors are related to sales and purchase. Creditors are related to purchase. So the annual net credit purchase divided by average payables. There is a printing mistake there. Average is written there. It should not be. It would be average net credit purchase divided by average payables. That would be the payable turnover ratio or the creditors turnover ratio. Then after calculation of the payable turnover ratio or creditors turnover ratio, we may be asked for computation of the average collection period. Average collection period. In case of debtors, average payment period. Here it is average collection period. 360 divided by the payable turnover ratio or creditors turnover ratio, that would give the result of average collection period. Then the next turnover ratio is working capital turnover ratio. Working capital means current assets minus current liability, or the net current asset or the free current asset. That is called working capital. Working capital turnover ratio is to be computed by dividing the annual net sales. The total net sales means sales. It has to be reduced by the sales return or the return outward. If there is any return against sales, that has to be deducted from the gross sales to find out the net sales. So annual net sales, that means whatever sales effected during whole of the year minus the sales returns during the year, that would be the annual net sales for the year. When that is divided by the average working capital, average working capital means working capital means current assets minus current liability. So current assets minus current liability at the beginning of the year plus current assets minus current liability at the end of the year. When whole is divided by 2, that will be the average working capital. So average working capital is the annual net sales is to be divided by the average working capital to find out the working capital turnover ratio. The higher the working capital turnover ratio, the lower is the investment in working capital, and together would be the profitability. And then we can go for computation of the total asset turnover ratio. Total asset turnover ratio is when the net sales is divided by the average tangible assets. Net sales is divided by the average tangible assets. It would be the total assets turnover ratio. Tangible assets means the assets are of when it is categorized basing on there are different categories of assets. It may be movable, it may be immovable, it may be tangible, it may be intangible, it may be fixed, it may be current, or it may be fictitious. Here, the tangible, intangible assets like goodwill, patents, copyrights, trademarks, technical know-how are not considered. Only the tangible assets are taken into consideration for determination of the assets turnover ratio. So when the net sales is divided by the average tangible assets. Tangible assets means it may be land and building, it may be vehicles, it may be plant and machinery, it may be furniture and fixture, it may be cash and bank balance. All these are coming under the tangible assets. Intangible assets means if there is any items like goodwill, patents, copyrights, trademarks, technical know-how, all these things are not to be considered. Only the tangible assets have to be considered, and the net sales have to be divided by the average tangible. Average tangible asset means the tangible assets at the beginning of the year, tangible assets at the end of the year, whole divided by the two, that would be the average tangible assets. And when the net sales is divided by the average tangible assets, that would be the total asset turnover ratio. Then the next category of ratio to be computed is fixed assets turnover ratio. Fixed assets turnover ratio is calculated by dividing net sales by average fixed assets. Fixed assets, as we know, the assets which are long term in nature. Fixed assets are those assets, the benefit from which will be derived in a series of future years. The benefit from which will be derived in a series of future years. Take the example of land and building, take the example of plant and machinery, take the examples of vehicles, take the examples of furniture and fixture, take the example of your fridge, refrigerator, air conditioner, blast furnace, etc., etc. All these things, when they are put to use, the income from those assets are derived in a series of future years. So those are the fixed assets. And average fixed assets means fixed assets are the beginning, fixed assets are the end, whole divided by the two. So when the net sales is divided by the average fixed assets, the resultant would be the fixed asset turnover ratio. So after computed, these are the 6 ratios under the turnover category, or which is otherwise called the activity ratios of the organization. Then come to the third category of ratio, third category of classification of ratios, which speaks about the leverage ratios. Leverage means it comes from the word lever. Lever means which facilitates, which helps in doing things in a perfect manner. The financial position of a firm can be studied and analyzed in two perspectives. One is short-term financial position and another is the long-term financial position. The short-term financial position is indicated by liquidity ratios, whereas the long-term financial ratios are indicated by leverage ratios. The long-term financial position can be analyzed by studying the major indebtedness and the measure of ability to service the debts, how to serve the debts. In this connection, in this, so far as the leverage is concerned, we can have a discussion about the financial leverage. The leverage is of 3 types. One is financial leverage. The second one is the operating leverage, and the third one is the combined leverage. Financial leverage is otherwise called the trading on equity. The financial leverage is computed by earning before interest and tax whole divided by EBIT, or earning before interest and tax minus interest minus preference dividend. Excuse me. What is financial leverage? Financial leverage is otherwise called trading on equity. What is trading on equity? Trading on equity means by keeping the equity, the volume of equity intact, how to infuse the loan capital or borrowed capital in the organization, as a result of which the EPS will go up and down. Take the example, I am giving an example, a numerical figure wherefrom we can calculate, or we can come to a conclusion that how the trading on equity takes place. Suppose there is one unit in one organization. The investment for that particular unit is say 1 lakh rupees, and its return is 30% or 30,000 its return. And at this juncture, the organization thinks of establishing a second unit which is similar to that of the first unit, which requires the same amount of investment, and it is also having the same amount of rate of return, that is 30%. That means additional finance required for establishment of the second unit or the unit B requires a fund of rupees, an amount of rupees 1 lakh rupees, which will give the same rate of return, that is 30% rate of return. Now there are two options in the hands of the organization. Either to go for raising equity capital for that 1 lakh rupees, issue of equity shares, or to take a loan from outside which bears a rate of interest at the rate of 10%. What should be the decision of the management, which should be better for the organization? There are two options left, whether to go for issue of equity shares or to go for arranging the funds from borrowed capital, from borrowed sources, by taking loan from bank or financial institutions, which bears a rate of interest of rupees 10%. Obviously, if we go for financing the second unit from borrowed capital, it will be beneficial to the organization. But we need to establish how. With the help of quantitative calculation, we must establish how. The second option will definitely increase the EPS of the organization to a substantial extent, which is not possible in case of first option. If the entire 1 lakh of fund is being arranged by issue of share capital of the organization, share capital to the equity shares are issued to the shareholders. When 1 lakh of additional equity shares are issued, suppose the 1 lakh share capital is the composition of 1000 equity shares of 100 each. 1000 numbers of equity shares of 100 each will bring 1 lakh rupees to the organization. The same was the composition of equity shares in case of establishment of the first unit. So in the first unit, when the second unit was not established, the investment was 1 lakh rupees, which was the composition of 1 lakh equity shares of 100 each, of rupees 100 each, and it was giving the profit, or the return on earning was how much? It was 30,000 rupees. So if we calculate the EPS in the first instance when the second unit was not there or not established, then 30,000 divided by 1,000 number of equity shares, the EPS would be 3. Earning per share would be 3. In the second case, when another 1 lakh rupees is also infused from the same equity shares, then the earning would be 30,000 plus 30,000. 30,000 for unit 1, it would be 30,000. For the unit 2, it would be also be 30,000. So the 60,000 would be the total earning. 60,000 has to be divided by number of shares, should also go up from 1,000 to another 1,000 because of the 1 lakh additional equity share capital. So the total number of equities would be 2,000 and the volume of earnings should be 60,000. So 60,000 divided by 2,000, the same 3 rupees would be the earning per share. But when the second option is exercised for establishment of the second unit, what will happen? Let us see. The earning would be, as the earning for the second unit is at the same rate of 30%, then for the first unit it would be 30,000, for the second unit it would be 30,000. So the total gross earnings should be 60,000, and from that we need to pay the interest at the rate of 10%. The loan was taken, loan bears the rate of interest at the rate of 10%. So 10,000 would be obviously paid towards interest. So that 60,000 of gross earning will be reduced to 50,000, and that 50,000 will be pocketed or will go to the pocket of the existing equity shareholders, and the number of existing equity shareholders is only 1,000. It is not increased. It remains same because the entire fund is being taken from the loan from outside. So the total net earning comes to 5,000 rupees, 50,000 rupees, 60,000 minus 10,000 deducted towards interest. So 50,000 is the net earning, When that is divided by 1000 equity shares, so earning per share became 5. So by establishing the second unit without increasing the equity share capital, when the entire amount is borrowed from outside, the earning per share is going up from rupees 3 per share to rupees 5 per share. So obviously, the second option is beneficial to the organization. That is called trading on equity or financial leverage. How the financial leverage is calculated? Earning before interest and tax divided by earning before interest and tax minus interest minus preference dividend. That is financial leverage. Accordingly, the operating leverage is also computed. Operating leverage is calculated by contribution. Contribution means sales minus variable cost. So contribution divided by contribution divided by EBIT, earning before interest and tax, that would be the operating leverage. And the combined leverage is, it is the financial leverage multiplied by operating leverage, that would be the combined leverage. That means EBIT divided by EBIT interest minus preference dividend, the whole multiplied by the contribution into EBIT. EBIT will be cancelled. The resultant would be contribution or sales minus variable cost divided by EBIT minus interest minus preference dividend. So that would be the combined leverage. So under leverage category, what are the ratios to be computed by us? Under leverage category, the first ratio to be computed under leverage category is capital gearing ratio. Capital gearing ratio is computed by equity capital plus reserves and surplus, which is otherwise called the net worth of the organization, or the amount due to the equity holders. That is equity capital plus reserves and surplus, whole divided by the preference capital plus long-term debt bearing fixed interest. It may be debenture, it may be long-term loan from banks and financial institutions. That would be the capital gearing ratio. Otherwise, there is another equation for computation of capital gearing ratio. It is fixed income bearing funds divided by the equity shares. That would also be the capital gearing ratio of the organization. Then, to measure the degrees of indebtedness, in case of liquidity category, to measure the indebtedness or the degrees of indebtedness of the organization, we can go for computation of the debt equity ratio. Debt equity ratio means, which it is an important ratio for the bankers and the financial institutions while making finance to the organization. How the debt equity ratio is calculated? The total debt divided by the net worth of the organization, and which can be otherwise calculated by the total long-term debts divided by the total shareholders' funds. That would be the debt equity ratio. The second ratio for computation of the degrees of indebtedness of the organization, that is the total debt ratio. In case total debt ratio, the long-term debts as well as the current liabilities, both has to be taken as numerator, and that has to be divided by the total debts plus net worth. That would be the total debt ratio. So these are the measure of degrees of indebtedness. Then measure of ability to serve the debts or service of debts. There are about 3 ratios coming under this category. One is interest coverage ratio. That means to what extent the organization is capable or is able to pay the interest on various loans to the banks and financial institutions taken by the organization. This ratio is also called the times interest earned ratio, and it measures the ability to pay the fixed interest liability. So interest coverage ratio is equal to EBIT divided by the volume of interest or the amount of interest. Earning before interest and tax divided by the interest, that would be the interest coverage ratio. How many times it is coming, the ratio is expressed in times. So how many times the organization is, how many times its EBIT is covering the interest component against the interest against the different debt taken by the organization. Then the second one is preference dividend coverage ratio. Preference dividend coverage ratio is calculated because it is one type of fixed liability for the organization. In case of preference dividend, the rate of dividend is fixed to them, just like interest on debentures, just like interest on loan from bank and financial institutions. So for preference dividend, how to ensure that the preference dividend, how the preference shareholders will ensure that they are the organization is having sufficient profit in its hand to pay their dividend from on timely basis from year to year. So to calculate this, the profit after tax divided by the preference dividend. So how many times the profit after tax of the organization is there, so that it can ensure the payment of dividend to the preference shareholders, which is a fixed rate of dividend for all times to come. So profit after tax divided by the preference dividend, that would be the preference dividend coverage ratio. Then the next one is debt service coverage ratio, which is an important ratio in case of banks and financial institutions for making advances, particularly in case of term loans. It is net cash accrual. Net cash accrual means it is computed by earning before interest and tax plus depreciation. Depreciation is a non-cash item. Depreciation is what? It is the gradual decrease in the value of fixed assets due to wear and tear, passage of time, or influx of time, or obsolescence. So that, although it is treated as an expense, it doesn't result into any outflow of cash. So for debt service coverage ratio, we need to calculate the net cash accrual of the organization during a particular period. So how to calculate the net cash accrual? We need to add the depreciation, which is a non-cash expense, to the EBIT, earning before interest and tax. That would be the net cash accrual, and that has to be divided by the interest and installment of the loan payable during a particular year. Interest for the year as well as the interest installments due for the year, that has to be taken as a denominator, and earning before interest and tax and depreciation has to be taken as numerator. When EBIT plus depreciation or net cash accrual is divided by the interest plus installment for the year, it would be the debt service coverage ratio. It must be 1.75 times and more for the organization, so that the bank would be in a safer position to finance the organization, particularly in respect of term loans, long-term loans. So this is about the third category of ratios which are coming under the leverage category. Leverage category, which speaks about the long-term solvency of the organization. Then the last category of ratio is coming under the profitability ratios. So these ratios measure the operational efficiency of the organization. The parties who are most interested in those ratios are the management and the equity shareholders, because the management will see that how efficient they are in earning the profit of the organization, how more the profit is, and the equity shareholders is also interested that how much of profit is the organization is earning, and accordingly the rate of dividend will be fixed for them. So they are very much interested on the issue. So what are the ratios coming under the profitability ratios, and particularly where the management is interested? First one is the gross profit ratio or the gross profit margin ratio. Gross profit ratio is computed by gross profit divided by the net sales into 100. Always the profitability ratios are expressed in terms of percentage. So the gross profit ratio is to be certain percentage of the net sales. How much of profit, gross profit is determined from the trading account, and when the gross profit is divided by the net sales into 100, that will be the gross profit ratio. Then operating margin ratio or operating profit ratio, that is EBIT, earning before it's a typing mistake, it is written as BBIT, it's not EBIT, it is EBIT. EBIT, or otherwise which is known as the operating profit, when it is divided by the net sales and it is multiplied by 100, it would be the operating profit ratio. Then net profit margin ratio or net profit ratio, it is the net profit or the profit after tax, when it is divided by net sales into 100, it would be the net profit margin ratio. Then expenses ratio. Expenses ratio is equal to cost of goods sold. Cost of goods sold. It is otherwise called the expense ratio is otherwise called the cost of goods sold ratio. How it is calculated? Cost of goods sold divided by net sales into 100. Cost of goods sold ratio or the expenses ratio is computed by cost of goods sold divided by the net sales into 100. Cost of goods sold means opening stock plus purchase plus direct expenses minus closing stock. That would be the cost of goods sold. There is another way of determining the cost of goods sold. Sales minus gross profit. Sales minus gross profit is also the cost of goods sold, the equation of goods, cost of goods sold. So after calculation of the expenses ratio, the next category of ratio, profitability ratio, where the management is interested, that is return on assets, ROA. Return on asset is calculated by dividing total assets, by dividing EBIT by total assets. EBIT, earning before interest and tax, divided by total assets into 100, that would be the return on assets. Total assets means it includes all the tangible and then as well as the intangible assets. Then the next one is ROI, return on investment. Return on investment. Return on investment is calculated by earning before interest and tax divided by the capital employed. Capital employed means it can be otherwise it can be expressed as net worth of the organization. This has to be divided multiplied with 100 because profitability ratio is to be expressed in terms of percentage only. So there is another way of determining the ROI, return on investment, that is net profit divided by net worth into 100. That would also be the return on investment. So these are the 6 types of ratios where 6 types of profitability ratios where the management is most interested. Then let us go to the profitability ratio where the equity shareholders are interested. Under that category, the first one would be the return on equity, ROE. Return on equity is equal to profit after tax minus preference share dividend or the dividend payable to the preference shareholders. That has to be deducted from the profit after tax and whole has to be deducted by the equity shares plus reserve and surplus. In other words, you can say it to be the net worth of the organization. And it has to be multiplied with 100 for determination of the return on equity. That means how much of return the equity holders are getting. This is in form of percentage. Then the most important ratio which is coming thereafter, it is EPS, earning per share. It is not expressed in terms of percentage, it is expressed in terms of rupees. How it is calculated? The earning per share is calculated by profit after tax minus preference dividend. And whole has to be divided by the number of equity shares. So that number of equity shares, keep it in mind, number of equity shares, although not the equity share capital, the number of equity shares, profit after tax minus preference dividend divided by the number of equity shares, that would be the earning per share. It is an important ratio, and in this ratio, most of the equity shareholders are very much interested and inclined to know about this. The higher the EPS, the higher the inclination for the equity shareholders. Then dividend per share, DPS. Dividend per share is calculated by dividing the total profit total distributed profit or the total divisible profit divided by the number of shares. Divisible profit, the dividend means how much of profit. When the profit is earned, after that the decision has to be taken by the management how much of profit is available for distribution and how much of profit is to be kept in the organization as retained earning, which is otherwise called the plowing back of profit. So the dividend per share or the amount of profit available for distribution, that is the total distributable profit, that has to be divided by the number of shares, that would be the dividend per share. So after dividend per share, then the dividend payment ratio, which is otherwise called the payout ratio or the dividend yield ratio, they are one and the same. DPR, dividend payout ratio, dividend payment ratio, dividend payout ratio. Payout ratio also it is called. So DPS divided by EPS into 100, That means dividend per share divided by earning per share into 100. That would be the dividend payout ratio. So dividend payout ratio, after dividend payout ratio, we need to calculate the price earning ratio, which is another important ratio, P ratio. For calculation of the P ratio, the market price per share plays an important role. Market price per share. So market price per share divided by the earning per share, it would be the P ratio. MPS divided by EPS, that would be the earning per share. So at the time when it is computed, that means the year, the particular period for which it is computed, by that point of time, what is the market price per share, that has to be taken into consideration for determination of the price earning ratio or the P ratio. This is important for the investors, that whether it is in an increasing trend, the P ratio, whether it is an increasing trend or in a decreasing trend, so that they will decide or they will make a decision about their future investment in the company. Then earning yield or the yield ratio. Yield ratio is computed by earning per share divided by market price per share into 100. It is just opposite of the price earning ratio, the yield ratio. Earning per share divided by market price per share into 100. Then dividend yield ratio. The dividend yield ratio is same as that of the dividend payment ratio or the dividend payout ratio. Dividend per share divided by earning per share into 100. So in this way, the calculation of different profitability ratios in which the shareholders are interested, that can be taken into consideration. In this juncture, in this chapter of what is that ratio analysis, another important topic has to be discussed. If it is not discussed in the thing, we cannot say that our discussion is completed. That is about the DuPont analysis. DuPont analysis, it was discussed in the year 1968 or something like that by the DuPont company. It was the particular person of the company was known as DuPont, who has advocated this analysis for the first time in the year 1968 to 70. In that case, what happened? The return on equity, if we look to this return on equity here, the profit after tax minus preference share or the dividend to the preference share divided by the equity capital for reserve or surplus of the equity. So this is segregated. The ROE is broken into its three important components. Return on equity is divided into three important components. The first one is profit margin. The second component was the asset turnover. And the third component was equity multiplier. The profit margin is computed by dividing the profit after tax divided by net sales would be the margin of profit or the profit margin, which speaks about the profitability of the organization. And the second aspect, the second important component of the return on equity would be the asset turnover, which can be computed by the net sales divided by the total assets. Net sales divided by the total assets speaks about the efficiency of the usage of the assets of the organization. And the third component is about the equity multiplier. Equity multiplier is computed by dividing the total assets by equity shares. Total assets divided by the equity would be the equity multiplier, which speaks about, or which is just like a proxy for the financial leverage. Financial leverage, which we have discussed in detail, which is otherwise called as trading on equity. So in case of DuPont analysis, the return on equity is just segregated into three components by further analysis, and accordingly a chart or an analysis, a flow chart is being prepared where three important components are given emphasis for computation of the return on equity. The first one is the profitability of the organization. Second one is the efficiency in the usage of the assets. and the third one is the proxy of financial leverage. These three things are taken into consideration for making a further analysis of the return on equity. So return on equity is computed as the three segmentation of this particular formula or the particular ratio, and these three ratios just like what the profit margin as the asset turnover and the equity multiplier, when they are combined together, the result would be the return on equity and nothing else. If we take the financial figure of any particular organization from the balance sheet, the combination of all the three ratios, that means the profit, the first one is about the profit margin, which is calculated by profit after tax divided by the net sales. The second one is the asset turnover, which is computed by the net sales divided by the total assets. And the third one is the equity multiplier, which is calculated by the total assets divided by the equities. When all the three ratios are combined together, the resultant would be nothing but the return on equity only. So this return on equity is classified by taking the three important components involved in it. And since the analysis was the first time done by the DuPont in the year, an American company, in the year 2000, in the year 1968, 68 to 70, the DuPont analysis was thoroughly discussed in the arena of financial management. So that is the segregation. The return on equity is segregated into three components. That is, the first one is the profitability, the second one is the turnover or the efficiency, and the third one is the equity multiplier. All the three are the parts of the return on equity ratio, and this is the classification or the further analysis or the further classification of the return on equity share, and the resultant of all the three ratios are just similar to that of the return on equity. And as because the DuPont was the first person to advocate this part of analysis, so it is titled as the DuPont analysis, and it was advocated in the year 1968. So this is all about the ratio analysis. Ratio analysis, which is a part of financial statement analysis. To summarize the things, we can say that in course of discussion of financial statement analysis, we have used different tools coming under the horizontal analysis and coming under the vertical analysis. Under horizontal analysis, the tools are there like a comparative statement analysis, trend analysis, funds flow statement, and cash flow statement. And under the vertical analysis category, we are tools like common size statement, ratio analysis, etc. But after all, it must be kept in mind that all these are tools available for financial statement analysis. Tools are just like tools. Tools means, take the example of a thermometer. What happens in case of a thermometer? Thermometer just measures the body temperature of a person, but it cannot diagnose or analyze that what type of fever the patient is suffering from. It is the duty of the analyst to make an analysis thereof, that what type of fever he or she is suffering from, and accordingly the treatment has to be offered. The tool cannot say that what type of treatment or what type of fever the patient is suffering from, and accordingly the treatment has to be offered. So although there are different tools are given for financial statement analysis, the role of the financial analyst is a must, and that plays a very pivotal role, and which cannot be ignored at any point of time. Tools are there, it's fine, but the tools are not the thumb rules for each and every situation. So it is the role of the financial analyst which is to be taken into consideration always for making an analysis of financial statements. Thanks to all.